assuming everyone can hear me. So thank y'all for listening. This is Trading for Beginner Space number 2. Space 1 didn't record, so we're going to pray this one actually works. The audio can be found on my new YouTube channel. I linked it in my bio if you guys want a recap of what we're going to cover. Please keep in mind that the audio might not be super clear as a lot of us are speaking into our phones. I already had someone complain. So if you're in here, bucko, you can buy me a new mic. So yeah, my name's Erin. I've been trading for about a year and a half now. I still consider myself to be a beginner, even though a year and a half is a good amount of time to learn what's going on in the market. But I love using this platform because I enjoy learning from others. A lot of us have had the idea of using these Twitter spaces as a cool way to connect and help each other to better understand the market. So each week, I'm going to be asking a few experienced traders a series of questions that we find are most asked when it comes to learning how to trade. So claps around the room for everyone that has volunteered to speak tonight, and every other Wednesday that we do this, you guys are really appreciated. Before we jump to questions, I just wanted to share a few tips that I wish I would have known when I started trading. Number 1, it's important to write down why you want to be a trader and also what type of trader you want to be. So there are 4 common trading styles. We have scalping, day trading, swing trading, and long-term investing. Think about your personal schedule and how much time you have on your hands to trade. So I personally work 9 to 5 as an electrical engineer, which is why I'm mainly a swing trader and a long-term investor. Everyone else is different. So it just depends on what you want to do. Before you start trading, it's very important that you do your research on the markets and write down what you learned. What sectors were hot at that time? Were small caps running? How were the OTCs doing? Then decide how much of your money you can dedicate to trading. Never risk more than you can afford to lose. And lastly, I cannot express this enough, have a trading journal. It sounds silly, but y'all will thank me later. I use a trading journal every single day. So with that, let's get started on Trading for Beginners number 2. Okay, everyone's unmuted now. I want to, got a couple of questions. So the first question is going to be over keeping a cash position and what's the importance of keeping a cash position, especially in today's market.
Well, I'll take that one first. One of the things that you want to have cash positions for is, in my point of view, you're a new trader, right? You pick up 1 or 2 stocks that were maybe greenish, or on the higher side, right? You're not reading their chart just yet. You don't know what the RSIs do. You don't know what's overbought, oversold. Cash position gives you a variable to be able to scale in to a trade, right? If I am trading with 500 and I put 400 on a play and it goes down, I only have very little capital to move into that. So you want to have cash for your, whether it's a swing or a conviction, just to be able to bring your average down in many or average up. You don't want to go all in too quickly because you don't know if there's going to be a catalyst to move your stock in a position where you're going to have to, reinvest more collateral. So I personally like to keep at all times between 20 and 30% of my trade account in cash. Some people say it's a little bit too conservative. I like that number because it gives me a lot of leeway to, again, scale up or scale down in any particular position I'm in, whether it's a swing, which I don't like to do anything same day because of the stop loss rules. But yeah, that's kind of my take on it.
And just to kind of touch up on that as well, it's also good to keep cash in your account pretty much at all times and kind of develop your own strategy based off of what Larry was just talking about with basically a type of ratio that you kind of want to introduce yourself into a stock. Basically, making it to where you can invest into a certain stock with 3 different percentages where, you'll make a starter position. And then if the stock goes down, you can put more into it so you can bring that average down. And then if it goes down a little bit more, you can finally put in your full position And you don't want to be in a position to where you put all of your money in at once and then you're stuck holding and waiting for the stock to go back up. So it's always good to have that trading plan where you can just kind of keep the percentages and then keep, you can either average up if you think that you need to, if you think that the stock's going to keep going, or you can average down and, to make sure that your position is not basically screwing you over.
I kind of, what I'm about to say is a little bit different than what they're saying, since the way I trade is also a little bit different than most people trade. We built our own tools and I've developed strategies off of that. And because of that, I play with a lot of options, more so than equity. And anybody who's traded options before knows that those can, the way they're leveraged, you can win big or lose big really quickly. And so it's really important. I'll find myself on days being 100% cash. And the reason I do that is because, and I make this mistake too, but a lot of times people feel like if they're sitting with cash, they're missing out, which isn't the case. Because if you end up forcing yourself into a trade that you don't have a lot of conviction about, or doesn't have, you don't have a good reason to be forcing in a trade, and you're only in a trade because you want to be in a trade, that can lead you into a pretty precarious position and end up causing you to lose a whole lot of money. And I've done that before. I've even blown up accounts because I bought into something that I said, I was just didn't see anything great on in terms of, tools or on charts or anything. But I'm like, I got to have my money in something, and then boom, have a blown up account.
I think option waves was trying to say something. I'll let him speak real quick. Yeah, and if anyone gets moved around, that might be me moving you down just so some other speakers can come back up. So.
Oh, sweet. Hey, thank you.
Yeah.
Well, kind of going off of what Sung was saying earlier, like keeping different percentages of cash in your accounts is always beneficial. And the way I treat my accounts, I see them as a business. And, your accounts are, your money-making businesses. And a business is either in the green, in the red, or in the black. And staying in cash is you're staying in the black. You are going to have those days where, you do take, 10, 20%, profits on these day trades, or you might have a longer-term swing. But like everyone else has mentioned, like if you're cash strapped, you're gonna have to liquidate other positions, or what other people have mentioned, use margin, which tread carefully doing those trades, because it's money that you're gonna have to end up.
But option, that is actually a damn good point for traders to know about. I don't even put it that way. If you're in multiple plays and you have an interest and you don't have cash, guess what you're doing? You're selling something that might be a conviction. And that's not always the case, but that's a great point to know for anybody. If you don't have cash, you're going to have to sell. And I wouldn't don't dabble in margin until you're going to have to sell something that you may or may not want to sell if you want to buy something else if you don't have any cash. So that's a great point, option.
Thank you.
Well, I kind of think that can lead right into overtrading and how that can get us into a lot of trouble. Does anyone want to speak on the FOMO that they've had and how?
Oh, even this week, hell yeah!
That? I mean,
this week alone.
We
Monday,
make those
Tuesday,
mistakes all the time.
Sure, me and Sung and a few of us, Robert, we tend to trade as groups in and out of these spaces, and I know that Monday, Tuesday, even Friday, it was great, right? Correct, good trades, good calls, conservative or aggressive, and then. Even today, I started seeing some stuff, and now I'm up in my gains, and I started pushing the needle, and I have cash, and start donating to the Wall Street Fund. And we're all guilty of it, every once in a while. You get excited, but you do FOMO. And the key to remember is that when you start realizing that you're bleeding into it, walk away. It is okay to walk away from the computer, the terminal, go get a cigarette, fresh air, whatever you got to do. It is okay to walk away. You don't have to chase it. If you're feeling that bug, you're chasing it. But absolutely, it's very, very common, and it's okay because it's human nature.
I look at AMC every day in FOMO. I'm just kidding. That was a joke.
No.
Yeah, kind of going off of over trading. I think everyone is guilty of it, and me personally, I'll go on like a a trading vacation, like little, kind of how Erin was mentioning how she works like a 9 to 5. I also have a 9 to 5. I'm a civil engineer. And, we all have, some of us have like full-time jobs, and we all can take vacation time. And, it's also good for the mind to take vacation time off of, trading. I come back more refreshed with the different pair of eyes, and, you may be, a directional trader where you're only picking, calls, or only picking puts, or, a specific trading style. But then when you come back into, the overall market, after a week or whatever it is, like, a couple days, you come back refreshed and, re-geared, and kind of get back into, your trading.
Yeah, I mean, just to kind of piggyback on that, like what Option was saying is that making sure that you're like really in the right mind frame, or like well rested, and that you're just in the right psychological mindset before you start trading is very important, because you don't want to make any bad decision, I guess irrational decisions. And I'll be honest with you, like about a week ago, I did it. I made there was a day where I made some trades on, and I was not. I just was not having a good day when good morning before I started trading, and I knew I shouldn't have traded, but I just started doing it, and I knew I shouldn't have. I kind of went outside my discipline, and I'll be honest with you, I lost my ass that day. I took a huge loss that day, and it happens to the best of us, I think. But that just reaffirms to me that, hey, you know what? Stick with your plan, stick with your discipline, and bounce back. And I bounced, and I came back on Monday. I took the weekend to gather myself and just refocus, and I came back on Monday and went back to work. And so, yeah, just make sure that before you start placing trades or anything like that, just you look at the trade and be like, and make sure that you're you evaluate whether you're emotionally making the right decision or not.
Yeah, that's really one thing that, to be a good trader, that's one thing that you have to teach yourself, is to be pretty much like an emotionless trader. You don't want to let your emotions ever take over what you're doing in the market, because that's when, FOMO happens and stuff like that. You make a bad trade, you get pissed, you're going to be like, all right, I'm doubling down. Well, that's how you lose more money, or you win big, you get a lot of confidence, and you're like, okay, I'm going to go into this one because I think it's going to do the same thing again. You have to remember that if you're not a very humble person in the market, that the market will humble you very quickly. If you're not
That's,
on your
to say the least, the Wall Street Fund, we're going to donate.
If you're not on your A game, if you're not emotionless, if you're not strictly business while you're trading, you will lose.
However you make your money in stocks, it doesn't matter if you made it on Palantir or BlackBerry or AMC, Best Buy, any stock out there. You're going to make money off of stocks if you position yourself well. It doesn't matter what that company did or what the stock movement did, if the stock's even correlated with the business anymore. You're going to make money, and you're going to lose money on businesses, and maybe it's not even correlated at all with the chart or with anything, with any of the tweets you're seeing or the paperwork filings, the S1 filings, all that fun stuff. It could just be the stock had a bad day with another stock, or just something that happened, and you can't blame yourself in a way, but you're the only person that can enter a position. Unless somebody else is clicking the button for you, then, hey, that sounds fun. If you want to do that for me, 9 to 5, that's great. Just let me know.
Another thing I'd like to add kind of about FOMO, and it goes back to, I don't remember exactly who said this, but about some of these, especially if you're following people on Twitter. I just want to say, just because somebody has 100,000 followers doesn't mean they know anything. In fact, a lot of these 100,000 follower accounts are able to slightly move markets and will sell into their followers. So just definitely be careful about who you're following in terms of that. And also, if you end up following green plays that people are tweeting about all all day on Twitter, something that's moved up 40% or 50%, and then you're buying into it, trying to maybe catch the next day. Typically the next day is very red. I mean, the strategy that I've built personally in iTrade is that I short super high sentiment and hyped stocks. I mean, literally, I look for these meme stocks that you'll see 100,000 follower accounts or big group traders trading that have run a serious amount, and more often than not, the next day there'll be a serious correction. And so yeah.
I mean, even to that point, it happened today. It happened today. The last 2 days, there was stuff that was running. People were chasing it, but you want cash for those trades as well, which is the key point to all of this. If you're going to go against the grain, that's fine, but you need cash as a position for that as well.
Yeah, I mean, to kind of go off of what Guru was saying is, you know what, on social media, obviously all of us are here on social media, and we, look through our Twitter feed and do searches and stuff like that. But, I mean, the reality is that even on TV or whatever, if you hear or read or whatever a catalyst on social media or see it on TV, it's already too late, right? Like you already missed, right? Because by the time you read it, the stock price has already jumped, right? Like whenever, like even I know there's a lot of like bio plays that, by the time you read a catalyst like that FDA there was an FDA approved or something, it's already too late. It's already ran up, right? So at that point, you're chasing, right? And that's just and it happens all the time. Now there's so just be careful what you read on social media or see on TV or wherever your news source is.
Right. Well, okay. So my question is, when these plays do have huge run-ups, what percentage do you see that they're up that you're not going to buy in at anymore? Like, is it 20% and you're not buying?
I'm cheap
30%?
as dirt. If it's 40 to 50 green, I'm done. Then I missed it. Now, there have been plenty of them that go 60, 70, 80, 100. Sorry. I clear my mind of it. It's not emotional because I know the moment I put my finger on the clicker, I already lost my money. So I'll do 5-10% runners with the condition, in my case, that I might use a day trade rule that day. Okay, I'll get in and out quick. I'll burn one, nice profit. But my number, again, I'm cheap. My number is at 30, 40. I'm probably not touching it anymore.
Yeah, I mean, let me put it to you this way, okay? Let me put it to you this way, okay? Like, how many of y'all had, like, entered a trade, right, that has already ran up? And then at that point, your mentality, the way you're thinking about it, is not necessarily when to cash out to take profits. All of a sudden, your mentality changes, though. When do I cut the loss, right? Almost immediately, right? That's not the position you want to be in, right? You don't want to enter a trade and then almost immediately be like, oh, my God, I got to, minimize my loss, right? So a lot of times, I mean, there's a lot of different variables that go into, like, I mean, you have to, to keep it, for me personally, if I see anything over like, I guess it depends. It also depends on the float and everything else. But if I see something up by, 6, 7, 8%, then I'm very, very skeptical on entering. I mean, you also have to like understand and recognize your own tolerance level. If you don't know your own tolerance level, then that's the first thing that you need to understand and realize. Like, hey, you know what? Let's say you have 10K in your account, right? And you put $1,000 into a trade, right? If you lose that entire $1,000, like, what's that going to do? You know what I mean? Like, you really have to evaluate what your tolerance level is before entering a trade. Hey, Aaron, can we bring up Ryan?
Yeah. Wait, Guru, you were saying?
Okay, so yeah, no, absolutely. I don't typically enter. I typically play bearish positions just because that's what I've realized I'm good at. And kind of going off of what Robert says, that you do absolutely want to look at volume on these plays. When I start entering my positions is when I start seeing that volume begin to taper off. I'll start entering my shorts or my puts and all of that. And just going back to social media, because that's kind of what we do, is we monitor that on a large scale. I see all the time people posting about, buying the dip, which is absolutely a great thing. when you're actually buying a dip. But one thing you'll see on social media all the time is a 200-300% run up and then a 10% dip, and people start telling you to buy the dip. And that's not necessarily a prudent strategy at all. The reason that these people are posting about that is because they're trying to find a way to exit there.
Hey. Did anyone else hear that? Everyone was talking over each other. Guru, you can finish, and then I think I want to talk about like level 2 data. So I think that's really important for finding volume. So here I'm going to unmute everyone. There we go.
I don't know where I got cut off, so okay, no worries.
Does anyone want to talk about level 2 data then, and how you are using it for volume?
I mean, I can start us off with level 2 data. I personally use level 2 data a lot when I'm actively day trading. I like to use level 2 data whenever I am looking at a stock that I'm day trading, and I like to see the flow of orders that are coming in. I like to see, what price there are heavy sells at, what price there are heavy buys at, and it allows me to kind of see, where the stock is going to bounce and where it's going to kind of fall off a bit. So while I'm looking at level 2 data, I can look and see, okay, there's a heavy buy order at this level, so I'm expecting the stock to go up a little bit. And then whenever I'm looking at it and it's going up, and then I can see, there's a heavy, sell order at this level, then I know it's going to fall down again and then dip a little bit. So if I'm day trading it, I'll know kind of my levels that I need to buy in, and then the levels that I need to sell at. And that's pretty much the only thing that I really and truly use level 2 data in. Is just, simply day trading and identifying the levels that I know that the stock is going to go up and down at.
I'm with you on that. I use it more for, in line with what you said, for risk management. Like, depending on which way I want to go with the stock, you know what I mean? I know, am I taking additional cash in my position to go, is it going down to a certain percentage where I think I'm fine? I use it very much, not for the, I can say, it is trading, but I use it more for my risk management side more than for volume is all good too, but I do use your concept on the risk management.
Yeah, 100%. It's really good for risk management as well. You get to see kind of where the the active buyers and the active sellers are, and you can kind of gauge based on that what the stock is going to do.
Remember that not everybody trading is not retail. There are big institutions that are involved, and they're watching the same Twitter accounts and the same Reddit feeds and so on. So if you see these big bulks of buy, that's price action for you. You might want, say, I see these big movements. That's maybe a good catalyst for you to say, okay, I'll dip, I'll go another few percentage. Or if you see small ones, that might, you'll start learning personalities, with the risk management. Like how does this, this stock feel in terms of movement, both in and out?
So are y'all using TradingView or FinViz or TrendSpider? Do y'all have a preference for someone that is starting out?
Yes, Ryan actually got me into the TradeView. I use Thinkorswim, and I don't like it for level 2. Webull, I've been playing with it, but TradeView is actually one of the better ones that I've seen in terms of a new trader, because that's kind of what Ryan teaches, is the new trader style. So I like it. That's the one that I personally have been dabbling with and like more than kind of the other ones. Even I've been playing with Benzinga and some other ones, and that's the one that I kind of feel like it's not hard to read if you're starting out or understand.
I think if you're new, Webull is also free. So even if you don't have a Webull account, you just download it, use it as a tool to kind of learn how to chart, how to draw support, resistance, use your moving averages, simple indicators like that just to start. Because a lot of traders, especially in retail, rural retail traders, start off on a platform like Robinhood and now SoFi, and then they migrate. And they're a little bit hesitant to use like Webull to buy and sell because it's a little bit of a fighter pilot thing. But just download the platform. It's 100% free on your app, iPad, computer. Use that to chart, and then if you need to go a little bit more advanced, the next step is TradeView, and then the following step after that I found is TrendSpider is one that I'm looking at now. It looks really good. But I'd say definitely stair step your way up. You don't want to, because you see a lot of charts with like a million lines, and they're a little bit daunting. Just start with the basic stuff and work your way up. But Webull is fantastic, and it's free, so you can definitely use that resource.
Let's move on to small floats and big floats in terms of sizes and how it plays into the movement of a stock. Yeah, does anyone want to add on that?
I mean, I can just comment on that. I think it's pretty straightforward. Sorry, I just got back from the gym, so I'm out of breath. But basically, with low float stocks, you're talking about the public float available. So, certain sources will give you different numbers, but they generally should be pretty accurate. And public float is just the amount of shares that are going to be able to be traded on the market and actively accessed by, retail funds, whatever it may be. And typically they lock out, a certain amount of the float. A really good example for a ticker that people are familiar with is Rocket, RKT. So,
did he say he's taking a call on my space?
Well, I think it interrupted him, but one of the simplest ways to understand float is that the lower the float, the faster the ticker will move or your stock may move. So if you start seeing something, running really fast, that typically means that there's a low float, which means there's going to be more price action. So you want to keep your risk management in that as well. You can go very, very quick in either direction. So keep that in mind. If you see something running, that's something you want to know about because sometimes you see it running and it's not low float. There's big buyers and so on and so forth. And you see that with some of these momentum plays where, they run. You just want to know that. You want to know that because it will let you know, hey, is this running? Can it run more? Has it run its course? And decide, am I taking profits or can it run more if there's more availability?
Yeah. Well, I want to hear from Ace real quick. For those of you that don't know, he's kind of running the Stocksman Discord for all the new traders on here. A lot of our speakers have their own Discords that you can join. They also post a lot of educational content. They trade live. So basically everyone up here, you should go give them a follow. But if you guys, Ace, if you have any comments you want to say, that would be awesome.
Specifically about low floats?
Yeah, well, low floats and then whatever else you want.
Floats in general, yeah, floats in general.
Look, if you're going to target low floats, that's a lot of the pennies that people like Atlas, Sapphire, and a lot of those penny floater people go after. It's very, you stack into a play with big buys and enough volume. Obviously, if there's less of something, less shares, it's going to run more violently and more rapidly. But take note that if it's running rapidly, it's going to come down rapidly. So those you have to be a lot more careful with in terms of getting your money and getting out because they fall as fast as they run. Mm-hmm. If you see something with a large float, like AMC, for example, running crazy, that means, it can't really fall the same way as violently because so many people already have and own the stock. So it's just the little things about float is just if you want something, you're trying to stack into a play with a small float and get that big boom out of nowhere. That's how you do it. If you're trying to grow in something consistent, look more for institutional ownership of the float. How much of the float is owned by big money? Look for things like that. And yeah.
Well, no, and to that point, we were talking about before things to look for in terms of like if you, Aaron had asked, well, where's your risk management on a certain percentage? So if you see something only up 5-10% and it has a high float, well, you could, there's a little bit more room, possibly to go. If you're at something 30, 40, 50% with a low float, you got to start deciding, like, am I going to enter or not? Because like you just said, you can go either way with your movement based on availability.
Yeah.
Exactly. That's a good way to put it. Exactly.
I've got a couple other people requesting if anyone wants to slide down for a little bit.
I also just wanted to speak on the low float. There are a couple people up higher with the big follower accounts that buy 4.9% of the float, which means that they don't have to file paperwork. But that takes a lot of the float away because they're buying 4.9%. And if a couple of their buddies do that, quote unquote, unknowingly and not coordinated at all and do it after, or, they do it after they call it, then technically it's legal. And I obviously don't want to call anybody out because they're probably making way more gains and way better trader than I'll ever be. But that is just something that historically has happened in the past that I've witnessed for the past year and a half now trading. And you'll just see something boom up one day and then boom down with no news. And you're like, what's going on? They could blame Chinese market manipulation. They could blame dark pool manipulation. Just keep in mind it's your money at the end of the day. So just put your money where you want it.
Perfect. Okay. Yeah, I'm moving people around. To keep it basic, I wanted to talk about options, very, very, very surface level for this space. But before we talk about options, we didn't get our first space recorded. So if anyone can touch on finding the best entry for a stock and what patterns to watch for, I just think that everyone in here could benefit from someone else's knowledge on when they're going to enter a trade. And then I promise we'll jump on options because that's why a lot of y'all are here.
I can kind of touch on it. Whenever I'm looking at swings in particular, and even day trades at that, also I really like to look at the chart that I'm looking at in particular, and I like to kind of see where my support and resistance lines are, and I like to see based off of previous candles, based off of previous data, where has the stock bounced from? Where do I know that it has strong support because the candles show that it bounces at that level? Where does it fall off at that level? So I can kind of see, and develop my trading plan based off of that. And then once I identify, the resistances that I see, I'll then kind of look at previous patterns that the chart likes to make, in previous like months and stuff like that, and kind of see how the movement goes and see if it's following any type of pattern, see if the current chart or the current time frame that I'm looking at, if it's following the same thing. If it likes to move the way that it's done in the past, and then I can evaluate the resistances, and if I think it's safe, then I'll go ahead and hop into it for a swing. Same thing kind of with a day trade. I'll look at the candles that are that are moving at the time, and I'll kind of see, okay, and that goes back to level 2 as well, and I'll see, okay, the candle is bouncing off at this price range, and then it's bouncing down off of this price range, and I can kind of evaluate where I need to enter, and then where I probably should get out in order to maximize the most gains.
Well said. Okay, I'm going to let y'all loose on options. That's why y'all are here. PBJ, options waves, guru.
Is this my time to shine? Because I will accept.
This is your time. Let's keep it surface level because I think we should do an entire space regarding this topic. But
oh yeah, no, of course. I mean, I can talk about options for probably a few days and probably lose or gain all of my money within that time period. But anyways, so the reason that options are popular amongst trading, amongst FinTwit, amongst anything, is that there is a lot of money to be made in any sort of time period and any sort of movement. So you could buy calls because you're expecting the stock to rise. You could be buying, near term, which would be like this Friday or next Friday, and all expires will be at the end of the week, or they'll be at the third Friday of every month. Those are called monthlies, which are also could be built as weeklies or even what I would call every daily or dailies for SPY. But basically, just going on with that, you're buying calls because you're expecting the stock to rise, and you're buying puts because you're expecting the stock to fall within a certain amount of time. And the more time you buy, aka the further out you buy these expiries, the more expensive it gets. And we can talk about, I guess, that later, but that would be with the Greek of theta. And we can talk about all the Greeks later, or probably in another space. But essentially, the reason there's so much money to be made is that when you buy a contract or you buy a call, you're not entitling yourself to one share like normally when you go and buy stock. You buy in shares, 1 share, 2 share, even fractional shares. When you're buying calls and puts, you're buying contracts for 100 shares per contract. So with the options, or with the delta gamma under it, and we can talk about that later, you could be buying something that really for every dollar the stock goes up, you're going to make $60 or $70 on your option, and even sometimes $100, depending on how in the money or out of the money. And we can talk about that later, of course. I'm sorry for saying that, but there's just so much with, little amount of time. But basically, that's why people really like options is you could make 100% in 5 minutes. You could make 1,000% in a week, depending on if you're right and if you're constantly directionally right. And that's where people go really wrong, because options also provide a 100% loss. Where if you buy a stock and it drops down 5-10%, that's okay. You're down 5 or 10%. But an option, it could drop 5-10% by the time you come back from the bathroom. right? And that's just something you have to keep in mind when you enter a trade. And that's why we've talked about, and Aaron's talked about, what type of trader you want to be. Because if you're trading these short-term options hoping to hit a home run, you can, but are you going to have the money to keep on failing and failing and failing to finally find that home run? And are you going to hold on to that home run and let it win? Or are you going to let it drop overnight, because options can only be traded when the market's open, not pre-market, not post-market. So as soon as that thing starts dropping overnight, you can start researching how to, cry and how to make more money at McDonald's. Because trust me, I've lost $15,000, $20,000 overnight because I was hoping that the stock would continue. And then some news happens or it just goes down, and I'm like, oh, this is great. The low volume of after hours is after me, specifically me, because, I'm that important. My, $20,000, $30,000 portfolio at the time, I thought I was really that important. But please, if you do get into options, obviously the best ways to learn them, as Aaron's talked about too, is writing down paper entries. But at the end of the day, mentally, you can go lose thousands of paper dollars, but you're going to learn a lot more losing $5 or $10 of your own money buying these calls or puts. Because it's your money. It's your hard work that's earned that. But hopefully it's maybe hard work. Maybe you just have money laying around. That's awesome too. But just going over that, you can make a lot of money. You can lose a lot of money. There's a lot of stock correlation, meaning that things that work in stock with support zones, resistance zones, or those EMA clouds, or, trading off the moving averages, trading off the RSI, the MACD crossings, the stochastics, and all those other things, supply and demand zones. All of that stuff can still apply to option trading, but I wouldn't necessarily say it applies to an option buying, because there's a big difference between buying a very far out of the money put compared to buying an in the money or an at the money put. There's a very big difference in the overnight playing and how the option Greeks works, and I would love to go over that. I've also described my way of trading with selling puts, because obviously if there's a buyer, there needs to be a seller. It's on my profile. I believe it's my pinned thread. It just goes through my entire strategy. It's probably 40, 50 things, and then there's a thread at the end where you can unthread it all, just in case you really don't like scrolling over 50 different tweets. But if you have any questions, my DMs are always open. I think you just need to make a request if I somehow don't follow you, and then we can go from there. And I'm sure there's way, way better speakers on this topic than me here, and I think they would also love to speak on how they make their money.
PB&J, thank you.
Yeah, thank you. Does anyone else want to let loose on that topic?
Yeah, so option way is basically just, right now we're alerting of unusual options activity that goes on in the market. Not to say that every alert is an actionable play, mainly because, PB&J, he did touch up on, theta. Options are a decaying asset. So the longer you hold on to an option, you're going to lose more money if it's not moving in your direction, and it's going to move faster if it's moving in the opposite direction. So mainly you can use it's a free tool that we have on Twitter and also on Discord, and just posting the different volumes. The way I use it, it's, you get a good gauge of where the market is going. If you see a lot of put volume, you can start to think about, bearish volume, bearish, a lot of call volume, bullish. But inversely, ultimately, don't put all your eggs in one basket. You can lose your hat really quickly. Just a couple of weeks ago, I was telling PB&J earlier, I was playing NVIDIA 0 days to expiration, which are options that expire on Friday. And, it was when NVIDIA, kind of went wild. And I thought I was the king of the world, because I started 0 days to expiration a little early on Thursday at like 3:58, So I opened up, very, very in the green when we had like a $10 or $15 spike. And I thought I was like Superman for a moment, and I was flying on cloud nine, and I went in and out of the trade a couple different times, and ended up giving it all back to the stock market foundation fund. So it's a dicey game. Don't if you have to be honest with yourself and figure out what type of trader you are. Like, I'm more of a swing trader. I don't have the time to, day trade as much, and it's really dependent on my work life. If work is busy, I'm definitely not day trading. If I'm on vacation, I could definitely use that time to, more actively day trade. But just figure out your process. I personally like swings, run ups into earnings. If I see companies are down, two months before their earnings, and historically they've had good earnings in the past, that's when I would look into buying swings, especially if I've seen correlating unusual buying activity at those different out of the money calls or out of the money puts. So that's how I use the tool. On the guide on it's a pin post on Option Waves. It's a pretty good guide of two different trading styles that I've anyone can just read and figure out. I mean, obviously you're going to have to lose your own money too to start to to practice, but they're pretty easy guides to just read, review, and get accustomed to trading options.
I know you mentioned, I think they both touched on it really well. The one thing I just, think that's really important to clarify is that the difference between options and buying shares is you really do not have a lot of room to be wrong. If you're wrong about your bet on what a stock is going to do and you're playing with options, as PB&J put, I mean, those things can go to zero so quickly. And if a stock goes down 5%, that could make your option worthless. So those thousands of dollars you put in are now worth $20 or $30. And so you really have to strongly believe in the direction of a stock, unless you're just gambling with it. And if you're going to play options.
The safest way to play options is play long. Go long. There's a probability calculator that shows the difference between weeklies and long ones, like a year out. If you're a swing trader, if you have time to be in a swing trade for 3 months, 6 months, whatever, decide to do long options. Your risk is much less. Your theta is less. You're not playing risky day trade types, things like this. A lot of guys who are listening are beginners, so any type of weekly or daily is just not for them. Something like a 2022 call on a company that has strong fundamentals, like earnings, like you could read those things that have positive earnings, like an Apple per se. If you got a 2022 in the money, like a 135 call, Apple's trading at what, 137 today? If you got like a 135 call in the money, 2022, it's not even really betting. It's the stock market has gone up historically for 100 years, so bias is upward. And then secondly is that you picked a company with good fundamentals, a name, and one that over time has shown continuous growth. So if you want to pick a really good option, you pick ones that are long out with companies with strong fundamentals, and give yourself some ample time to not lose too much if the trade really does not go your way.
I kind of came in here late, but I mean, I assume you guys are talking about just options for beginners. The two things that I will say are, number one, be careful about averaging down when you're wrong. A lot of people think that because, their option lost 70% in value in 2 days, that it's like a clear-cut opportunity to average down, especially if there's shorter expiry options. That is not the case. In most of those cases, you're just going to be dumping more money into a losing trade. Options can go from down 70% to down 98% very quickly. So just understand that averaging down on options is not as easy as averaging down on equities. If you're even a slightly decent technical analyst, and you can find a decent entry point at support, you may not have the bottom, but you can average down more flexibly with equities than you can with options. And the second thing I would say is, if you're purchasing, options on the open market, try not to purchase them right at open. You generally have inflated implied volatility at that time. And also pay attention to the spread, because some people, a lot of new option traders I know, go straight, to purchasing an option and they just buy it at whatever they think is market value, or they might put a bid in like, a couple cents lower. But in a lot of those cases, especially on low volume options, you can get a much better price if you're just aware of the spread between the bid and the ask, and, aware of when implied volatility is inflated, which it is very often, in the first hour and a half of trading, and when it's not. And another thing about that is be careful if you're playing in earnings, not to jump in, super close to the earnings, because a lot of the times, especially if it's an anticipated good earnings report, you're going to see a lot of that IV factored in before the fact. And so you may be buying an inflated option, in a case where you shouldn't be. So just pay attention to, I think the two most important things for beginner is, in my eyes, is pay attention to the bid-ask spread. Don't be in a rush to, pick up calls or puts or whatever you're picking up. And then, pay attention to the IV and the spread, and just make sure you're not, screwing yourself over.
Okay, I think we've got 3 more minutes if anyone else has something else they want to say, and then I'll close.
For the option price, just one thing that I believe Stock already mentioned is that when you buy an option, there's 2 different things usually. There's a bid and an ask. So usually when you're a buyer, you want to try for the bid, but if you get FOMO, people say or quote that they quote unquote slap the ask. And what they're trying to say is that they're so bullish they will pay up for more, which is fine, but all that you're doing is just giving the seller or the writer more, which is fine if you are completely bullish and you think this is the bottom. But if you're right 100% of the time, like I've said before, please let me know what you're doing every single time, because I would also love to be right 100% of the time.
Okay, well, I think we just hit our hour mark, so I'll probably end the space. If y'all are on here and you want to hop over to another space, a lot of these guys will be on talking about stocks or just socializing. I want to say thank you, everyone, for hopping on. I seriously can't thank the speakers enough for giving away free knowledge every week like y'all do. We use these spaces to give back to the community, and frankly, majority of the people on here generally care about helping. So I'm going to be hosting these spaces covering different topics each week. So if you have something else you want us to discuss, feel free to send me a DM. And if for some reason you missed some of what was said, the audio is always going to be posted on my YouTube channel. So again, thank y'all. We'll go ahead and end it, but I hope y'all have a great night.
Thank you, Aaron.
Thank you, Aaron. Have a good one.
Talk to y'all later.
Thank you.